Markets crash, they always have, and they always will. But if you study the past, you can not only survive the next downturn, you can position yourself to win while others panic. Hey, I'm Robert, and welcome to The Alternative Investor. Today we're diving deep into over a century of stock market crashes, from the Great Depression to the COVID crash, and pulling out 5 timeless lessons that every investor needs to understand. These events shaped global economies and destroyed trillions in wealth, but they also created massive opportunity for those who knew how to read the signs and stay steady. Since 1929, the stock market has experienced more than 20 major downturns, some triggered by speculation, others by war, inflation, or poor policy decisions. In 1929, the U.S. stock market lost nearly 90% of its value as the Great Depression took hold. It was a painful crash that took over 2 decades for the market to recover from completely. Fast forward to 1987's Black Monday, and we saw the Dow plunge 22% in a single trading session. Still the worst one-day percentage drop in history. In 2008, the global financial crisis wiped out more than $2 trillion in retirement savings, with markets tumbling and unemployment spiking. And more recently, the COVID-19 crash of March 2020 saw the S&P 500 fall more than 30% in a matter of weeks. Yet remarkably, it bounced back to new highs in less than 6 months. The lesson is clear: no matter how deep the crash, the market has always recovered over time. Crashes are inevitable, but recovery is historically just as reliable. Throughout history, investor behavior during crises has proven more destructive than the crises themselves. In 1929, the crash and ensuing panic caused widespread financial ruin, with many investors facing margin calls they couldn't cover, leading to a wave of suicides and bank failures. In the early 2000s, the dot-com bubble drove tech stocks to astronomical valuations. As euphoria took over, investors piled into unprofitable companies. When reality hit, the Nasdaq collapsed by 78%, and panic selling accelerated the collapse. During the COVID crash of 2020, many retail investors panic sold right at the bottom, only to watch the market stage one of the fastest recoveries in history. These emotional reactions locked in losses that could have been avoided with a long-term strategy. The big takeaway? Emotions, especially fear and greed, are the enemy of successful investing. Staying calm and following a clear plan is more powerful than trying to time the perfect entry or exit. One of the greatest defenses against market crashes is a diversified portfolio built on quality. In 2008, portfolios concentrated in financial stocks, especially banks like Lehman Brothers, Washington Mutual, or Bear Stearns, were decimated. Investors who had all their eggs in one basket learned that lesson the hard way. But those who diversified across sectors, like consumer staples, healthcare, and even commodities like gold, weathered the storm far better. Defensive stocks with strong earnings and low debt outperformed their riskier counterparts. In 2022, rising interest rates punished speculative tech stocks with weak fundamentals. Meanwhile, companies with consistent cash flow and durable business models, like Johnson & Johnson or Procter & Gamble, remained resilient and continued to pay dividends. The historical pattern is clear. Diversification reduces your downside, and owning high-quality companies with strong balance sheets keeps your portfolio standing even in a storm. While leverage can enhance gains in a bull market, it can be catastrophic during a crash. The 1929 crash was a prime example. Many investors had borrowed heavily on margin, and when prices started to fall, they were forced to sell into a collapsing market. This led to a cascade of margin calls that deepened the collapse. In 1998, Long-Term Capital Management, a hedge fund run by Nobel Prize-winning economists, nearly brought down the financial system due to excessive leverage in complex derivatives. It took a coordinated bailout from major banks to prevent a full-blown crisis. The 2008 financial crisis was also driven in part by excessive leverage in the mortgage-backed securities market. Banks and investment firms loaded up on debt to increase their returns, and when the housing market crumbled, those debts became toxic, sparking a global financial meltdown. The lesson here is timeless. Leverage magnifies everything. It makes good times feel euphoric, but in bad times it's a wrecking ball. Keep your exposure in check, especially in volatile markets. Market crashes often expose the flaws in the financial system, and historically they've been followed by reforms that strengthen the investing environment and create long-term opportunity. After the 1929 crash, the U.S. passed the Securities Act of 1933 and established the Securities and Exchange Commission to protect investors and restore trust in the markets. These were foundational changes that still shape how stocks are traded today. The 2008 crisis led to the Dodd-Frank Act, which introduced new banking regulations, capital requirements, and oversight of the derivatives market. It forced institutions to hold more capital and operate more transparently. Even the COVID-19 crisis, while not regulatory in nature, sparked massive acceleration in tech innovation. Remote work, digital infrastructure, fintech, and e-commerce all exploded, creating new investment opportunities in companies that adapted to the shift. The key insight? Smart investors pay close attention to what follows a crash. The reforms and innovations that rise from the rubble often create the next generation of winners. Stock market crashes are a fact of life, but they don't have to be devastating. History teaches us that recovery is possible, fear is costly, and strategy is everything. If these lessons gave you more clarity or confidence in your investing journey, do me a favor. Like this video, subscribe to The Alternative Investor, and leave a comment below. What's one lesson you've learned from a market crash? I'm Robert, and I'll see you in the next one.